One of the most popular widely used technical tools in trading is moving averages. Because they are used by so many traders, it is good to have them on your price charts to know what other traders are looking at. When it comes to trend trading, traders usually use a combination of fast and slow moving averages to analyze the instrument. In this Forex trading video, I will be showing you how you can follow this approach and show you a slightly different way to use the moving averages when you are trading. Before I go on, I would appreciate it if you could take 3 seconds of your time to like this video and subscribe to this YouTube channel. There are a ton of Forex videos on our channel which are designed to help you become a better trader. I also have a free day trading guide which you can download via the link in the description below. So a moving average strategy can help you identify the trend direction as well as the trend strength. For this video, we will be using two moving averages, a slow moving average of 55 and a fast moving average of 21. Now you might ask, why are we using these numbers? That's because these are Fibonacci numbers. You can however backtest and tweak the values of the moving averages as you like. What is important is that you learn how to read price action while using this approach. So in this strategy, we will be using the 21 and 55 moving averages. This setup will provide a good indication of the trend strength on a slower and faster time frame. Before I show you how to apply this strategy, let me first point out that this is not your typical moving average crossover strategy where you enter a trade when a fast moving average crosses a slow one. While that strategy is perfectly normal and valid, I like to show you a specific repetitive pattern that I have observed rather frequently. Now, remember that moving averages are simply indicators that indicate the conditions in the market. By itself, they are not entry signals that tell you when to buy or sell. Rather, they are meant to be used as a tool when analyzing the market. When applying this strategy, the main idea is to look for both perspectives, both the short and long term, to make a more informed decision. While the 21-period moving average is situated more closely to price and hence results in more touches, the 55-period moving average gets significantly lesser touches. There is however a different way to use the patterns of the slow and fast moving averages. And because it is somewhat similar to the Bollinger Band indicator, I call it the widening and tightening principle. This widening and tightening principle is not based on when the moving averages cross over but rather focuses on the distance between the two moving averages to determine the strength of the trend. The wider the distance between the 21-period moving average and the 55-period moving average, the stronger the trend. Why? Because when an instrument is in a strong trend, the price will pull the 21-period moving average with it quickly, and this in turn causes the moving average to diverge further away from the 55-period moving average. This is what I call widening. Now as price pulls back or makes a retracement, the 55-period moving average will slowly catch up with the 21-period moving average, thus closing the distance between the two moving averages. This is what I call tightening. What I want is for price to bounce off this zone and break out into a trend. Let's look at an example to illustrate this. In this case, we have a clear downtrend with frequent but shallow pullbacks. Notice how the distance between the two moving average stays fairly consistent and reflects the smoothness and consistency of the trend. When price does pull back, it is resisted at the dynamic zone created by the 21 and 55-period moving average. Such price action is very common when the market is trending strongly. Here's another example where we see a deeper pullback in price. What is interesting is that there is also the tightening of the moving averages where the distance between the 21-period moving average and 55-period moving average tightens. Essentially, the 21-period moving average gets pulled back up with price near the 55-period moving average, and thus the gap between the moving averages tightens. Now if the trend is strong enough, we can expect the tightening of the moving averages to uncoil and release price back in the direction of the trend. Think of it like a spring that has been compressed. Do keep in mind that like most technical indicators, moving averages are lagging in nature. This means that they react after the price has moved. It also means that the tightening of the moving averages isn't the reason for price trending. It is rather just an effect of price resuming its trend. Let's take a look at another example to illustrate how you can use the 21-55 moving average trading strategy. This time, we are looking at an uptrend that runs out of steam and transitions into a consolidation. Each of the pullbacks results in a tightening of the moving averages and causes the price to carry on trending in the original direction. But notice that as we approach key resistance, an extended pullback happens. This extended pullback does not result in price resuming the current trend. You should note that the price stalled at the crossover of the two moving averages and reverses back down. This is a strong sign that price is either transitioning into consolidation or making a deeper pullback. So let me now walk you through the steps of this strategy. First, We analyze price action to look for tightening in the moving averages. We are looking for pullbacks into the zone of support or resistance that is created by the two moving averages. By watching how price behaves as it pulls back to the zone, we can determine the momentum of the current move. We want to see a sharp move back in the direction of the trend when price pullbacks to the zone of support and resistance. Next, we need to add other filters into our analysis to ensure that are only trading the high probabilities. As mentioned earlier, when looking for a trend continuation play at the dynamic support and resistance zone created by the moving averages, it is also important to ask yourself if the current trend still has room. Some other questions to consider. Is price near a higher time frame support and resistance level? Does the dynamic zone also line up with the market structure? Is the trend headed into a key swing high or low point? These questions will help you build an overall understanding of the market and help you find high probability trades. The last step involves trading a breakout after the price resumes in its initial direction and is supported or resisted at our dynamic zone. Or as explained in our free day trading guide, this is what I call an entry trigger. An entry trigger means that we have momentum on our side and we want to ride this momentum wave. Specifically, we want a trend line breakout or a swing breakout. In this example, we see that the dynamic zone created by the moving averages acts like a magnet because the price has strayed far from it. We see that price was also unable to go lower, which is one of the criteria of this strategy. We also see a breakout play here out of the wedge pattern indicated by these lines. A classic price action-based entry. As you can see, applying this strategy requires knowledge of candlestick patterns and understanding price action. These are covered in our free day trading, so make sure to download a copy via the link in the description. Patterns such as engulfing candles and pin bars are also ideal as an entry trigger. Now regarding your stops, we will logically set our stops above or below the dynamic support and resistance levels, depending on the direction we are taking. As for your target, it is good to aim for at least a risk-reward ratio of 1 to 1.5 so that you have the best chance of making money with this strategy. Let me walk you through another example to show you how you can use this strategy. Here is a short setup. We see the tightening zone here, being tested by price a couple of times. Notice that price was unable to break above the zone. This means that sellers are in control and it is wise to stick to selling. We enter short after the breakout of the range. Now you might ask, why did we have to wait for a breakout and not simply enter when the price was trading at the tightening zone? Well, that's because we wouldn't have known that the zone would hold in real time. Therefore, waiting for an entry trigger helps us make a deduction that price is resisted at the zone and wants to go down lower. It is important that you wait for a price action trigger and not enter earlier without any form of breakout confirmation. So just to be crystal clear, you want to wait for price to return to the dynamic zone created by the moving averages and watch for price to be support or resistance. Then you want to look for an entry trigger in the direction of the two moving averages and the prior trend. Another cool tip I can give you is to pay close attention to the slope of the moving averages. The slope of the moving averages can tell you a lot about the strength of a trend. If it shifts from a steep angle to a more gradual angle, it is an early warning that the trend is weakening. Remember that this is not a perfect strategy and you will encounter losing trades. Just make sure to manage your risk well and backtest his strategy thoroughly. Here are more examples of valid trades. If you have gotten value out of this video, please leave us a like to show your support and do smash the subscribe button and turn on the bell icon so that you wouldn't miss any new videos that we create.